Hey, on this video I'm going to do a walkthrough of the option investor's climbing valleys indicator and how I'm using it. So the indicator is basically here, it's these arrows of two different colors, these dots of two different colors, these lines of two different colors, actually three different colors. This is all one indicator here. Also it has these kind of information labels at the top. So first of all, there are two separate setups in here, the high valleys and the deep valleys setup. By the way, there is one extra thing on my chart. I've simply plotted the exponential 34 period moving average here in the middle. So that's the only thing. Then I have these two indicators hidden because they have nothing to do, basically. They're like other stuff that are not used here. So the idea is that when there is an arrow of white color, that's a high valleys buy trigger. If there is also a white dot, it means that the strategy simulator took that trade. The trade was entered here, and the trade's target is the white line above. Now we see that in 1 and 2 days the target was hit, therefore there is no more trade open. The next time there's a trigger, a white trigger, there's a white dot. An orange trigger, so a deep valley, there's an orange dot. There are some other high valleys triggers, but there are no more dots because the trade simulator already took the trade. But if you missed that day, you totally could buy any of these later arrows, because if you trust that the trade wins almost 80% of the time with 15 years of data on the daily chart here, you may think that, oh well, I missed that entry, but hey, how about I buy the open here because it's actually lower? Or why don't you buy this bar here? Oh, that's actually the deep valleys entry. Anyway, because if this has 80% hit rate, if you can get the same trade cheaper the next day, it's actually going to be better for you than this for the win size if you win, and your lose or loss will be smaller if you happen to lose. So you don't need to enter on the dot. It just shows you on which entries the statistics up here are based. The same goes for the orange charts. And now there's the white exit was taken here, the orange exit was taken here, so that was a win as well. Then there's no trade, the price runs, the next time it dips, there is a high valley entry, it goes very nicely just to the stop loss before turning around. Well, bad luck for the trade. Kind of a crappy loss there, but well, that's how the system behaves. And if your stop loss is somewhere here, if you set it at the entry, actually if you set it at the entry here, then technically you may still be in the trade, but the simulator machine is no longer in the trade. So if you want to respect the strategy exactly as it's written in the code, so that you can get exactly the kind of results indicated in here because you behave exactly like the machine does, in that case that would have been your exit point. And then of course the next day you are like, oh damn, oh damn, oh damn, oh damn, I would have won. Well, too bad. Well, that happens. And we never know. Of course, it could have just like kept falling. We never know. There's another high valleys entry here. Well, I didn't see it before here, so I actually bought the same signal yesterday. Pretty much the same price as well. Of course, I would have got a much better price had I seen it a few days earlier, but I did not. So anyway, since I thought that I like to win 80% of the time, I took the trade here. Now it's slightly up on my real account. This is a simulated TOS account. I am not American, like you probably know, so I can't have a TOS account. I don't have an LLC in the USA either. So for as long as they don't change their rules, I can't have a TOS account, but I can use this for charting and stuff. and that's what I do. So anyway, now it's slightly higher, still I'm a small profit, and I'm aiming somewhere here with my trade. I hope it works out. Well, it always doesn't. If it falls down here, I'm gonna take an exit, and then I'm going to take a loss. That's okay. So that's how this is traded. Very simple. You buy on the arrow, and you exit when the price hits your target, or you exit when the price goes to your stop. That's like every trading system pretty much works like that. The difference here is you just see statistical data. So if you behave like the strategy tool tells you to do, you can expect to have this sort of results. So for applied materials, the win rate is quite good. The profit versus loss is not very good. I'll show a better chart. For example, Dow Jones is fantastic. Here, it may take some time for this to go through the 15 years of data, so these numbers may change. Now it changed a bit. The return on risk is still infinite because this hasn't lost within the past 11 trades, but now it has some losses too, so this becomes like non-infinite. I need to edit the code at some point to take that stupid numbers away, but it's kind of enough to know that when it shows that kind of number that doesn't make any sense, it just means that it hasn't lost yet. And now, of course, this is like amazing. It wins more than 90% of the time. When it wins 11 times more than it loses when it loses. So whenever Dow Jones has a deep valleys trigger, guess what? I'm gonna take the trade. There are no questions asked. If I lose now and then, so what? If I take this every time I get a trigger, I'm gonna be a very happy camper at the end. Pretty much the same goes for the high valleys. Now if I win 3 times out of 4, slightly better. It's actually the applied materials high valleys was better than Dow Jones high valleys. So that's something to pay attention to as well. The PL, I believe, on this one is slightly larger. But the Dow Jones deep valleys, they are crazy good. There's, for example, Microsoft as well. I believe that they had like mind-blowingly good results. Now again we have infinite on the deep valleys. Now it goes back to like reasonable, understandable numbers. Let's wait a while more. Anyway, the logic is always the same. You buy the arrow, then you sell the exit, and that's how it works. Makes kind of all the guesswork out of trading, which is what a good strategy should do. But in addition, because this is not just a strategy thing, this is a trading system, this actually tells you what to expect. And when you have a good chart with good stuff to expect, then I believe you may want to make the decision to actually trade this thing. And when you see a crappy chart, now I don't remember, I think, what was it? I did a video on this a few days ago and I found a bad chart. I think it was Lumen Technologies, we'll check that soon. But 80% of the time Microsoft deep valleys win, 3 times larger wins than losses. Well, Dow Jones was 7 times bigger, so that's like much better, but this is still good. A 79% win rate on high valleys, 1.7 times bigger wins than losses. Well, of course, like if you understand compound growth and that sort of expected returns, you will see very clearly that this is an unfair advantage, which is exactly what we want to have as traders, so that basically we can grow the account from low value on the left to high value on the right, pretty much as just like this chart here is going, except that with options, when we do that with options, then our growth speed is well, quite wild, we can put it that way. Now I'll show you the bad chart so that you see that this is kind of like, when you have something like this, you may decide that okay, this is not so cool. Actually, this, with 15 years of data, this is not so bad. I wonder what kind of, okay, yeah, the high valleys starts, yeah, okay, this is not very good, I wouldn't trade this. 1.2, 64.3, there is some edge, sure, but there's not that much of an edge. The win rate here, 67.2, well, sure, okay, but profit versus loss of realized trades, it's more or less flat. So again, there's no such a huge edge, and since you now have this data, or if you have this indicator, you have this data, then you can start to get a little bit picky, and you just don't trade those less than perfect charts because it's so easy to find those better ones, right? So I'll go back to, let's say, S&P 500. That's a good chart as well. I'm gonna go there, and then I'm going to show some configuration options that we have in here. Here again, the win rates are quite spectacular. There was an entry. Of course, it would have been better now to wait the next day. Well, guess what? I've got a mode for exactly that. When we go here, we've got this thing. Show data for, first of all, if this is an ICE, or if you don't want that much information, or if you want just to see high valleys or deep valleys or no data whatsoever, you can change the mode. The compact mode kind of removes most of the data here, so that makes you save a lot of screen space, and that's okay. Now it disappeared. What happened? Okay, there it comes. So this kind of cuts the amount of data to a minimum. I want to have more data as an option trader. Actually, I want to probably add just to this mode the fact that it shows the maximum time in the trade. We didn't go through the data labels yet, but that's something I want to know, so that when I set my, let's say, spread or calendar trade, or like vertical spread, calendar spread, diagonal, whatever I do, I want to know that there has never ever been a case that takes longer for me to take my trade to the max victory than the time that I'm giving it. So if I put the full data mode back on, I'll tell you what that is about. That's basically me seeing here that the longest duration is 49 candles. So it means that if I give my trade, let's say, 60 days time, even in the worst case scenario, if now we have like 20% longer duration than ever before within the past 15 years, 3 out of 4 of my trades will hit the victory. And when I set that as a vertical call spread, let's say, so that my sold strike is below the target level, it means that I will be getting maximum wins all the time. And that's how we grow accounts fast. Alright. Well, I think this is ROR, by the way, means return on risk. It's calculated from the win rate, the historical wins versus historical losses. Means basically that if I put $1 in, for every $1 in, I can expect to get $1.98 back. So 98% growth to every dollar I risk. Here it's 247% growth. So for every $100 I risk in this trade, I'm expecting to get 347 out when I close the trade. On average, over 15 years. Of course, it doesn't work like that every time. And this is, by the way, the stock data. Now, when you're doing options, when you're planning your trade so that you kind of like utilize the leverage and so much better, of course these numbers will explode, but I haven't simulated. I haven't even tried to simulate that. When something wins that much on a stock alone, I just kind of know that when I do it with options, when I apply leverage, that will just like make it stronger, right? Then there are some data like on average the wins are this and that much larger than the losses. We always want this to be higher than 1. Well, I actually want it to be much higher than 1 to like really care. Expected result, this is kind of the average average gain on the trade. Average win side. Okay, these are slightly different. I don't remember what's the difference between these calculations, but if there's a huge difference in here, like average win, oh yeah, average win, of course, like because there are also losses. Average win is 2.7%, average loss is minus 0.9%. So the average expected result is somewhere in between these, depending on how much more this wins than loses. Average durations kind of tell what I should expect to at least spend in the trade. The losses are quite quick, sorry for coughing. The longest duration for option traders, that's critical. This is just like nice, who cares what's the biggest win. I don't care too much what is the biggest win. I care about my option spread going to max victory. That's what I care about. So back to the settings. The show data mode was here. Buy strategy. Yeah, okay, that was a super long kind of open loop. Sorry for that. Like, I think I said that, okay, here I saw a trigger, I would have bought this. Well, now, if I actually went to bed before the market closed, or I was reading a nighttime story to my children, which quite often happens at the same time as US market closes, I can change my buy strategy to next bar dip, and that allows me to not even care about where the price closes. I check the values the next day, and then if there's a dip the next day, I buy that dip. Now, interestingly enough, the win percentages drop on the high valleys while they go up on the deep valleys. So, tomato, whatever. I don't know which one is better on which chart, but it's just like here, for example, this could have probably been a high valley trigger. It's almost in the range, but the next bar didn't dip, so of course we missed that win. Now, that would have been the target here, so the target would have been hit just before the dip here, if somebody would have bought this one. On the next bar dip setting, there was nothing to do. On here, there was a trigger, the next bar dip buys this one. Here was a trigger, the next bar dip buys slightly below. There's a trigger. Actually, there's a trigger, the next bar doesn't dip, so there's not a buy. There's another trigger, the next bar dips, so there's a buy, and therefore we get a better price. Of course, by waiting a little bit longer, we could have received even a better discount, and then pow, shoot right to the target, and that's what we like to do. The last one here is well, I've got an indicator called Karinen movement direction. I'm not going to show it now, but it's kind of a directional movement indicator convolution, and in some cases I have found that it's interesting to see if I require that to be rising or falling during the trade, does it kind of change something in a meaningful way. Sometimes it does, sometimes it doesn't. Then the targets, like you see, sorry again, are taken from the average true range. And this is me being a bad programmer. I could not figure out how to write 2.5 and make it work. Therefore, I mark 2.5 by writing 25. That's just 2.5 average true ranges above the center of the buy zone. And you can set different targets for high and deep valleys, different stop and different stop loss levels for high and deep valleys as well. And that's kind of when you change that. If I put that to 35, for example, that probably makes the hit rate lower, because now we're aiming higher. Hit rate only 58%, so that was a bad move. But you can change these, because for different charts they work different ways. If I make it only 20, I wonder how that changes. The hit rate becomes 76-ish. I don't know if it's improved at all. So maybe, like, this is interesting testing to do if you want to spend some time on it, or you just go with the standard settings. I think it was 25. Because I think it was, no, 76 is much better than 67, so it may make some sense sometimes to aim lower. It depends on what you want to do. But anyway, that's the kind of setting. So you can decide where the targets are, where the stop levels are. You can see how changing those targets and stops modifies your parameters, so that you can kind of get the kind of win rates and PL ratios that you like to have. and find what suits you. Then the strategy indicator or the strategy system gives you the buy triggers and the exit triggers here. You can choose the mode. If you're watching the charts, you want to go with trigger bar close. If you're not watching the charts around the daily close or the close of the bar, you may want to use the next bar dip setting. Also playing with that, yeah, okay, 75% here. So I just remembered wrong. Of course, since this is an indicator, like if you change that to hourly chart, it's gonna change it to hourly. 75, 71.4. So the deep valleys on hourly are not as good as they are on daily. These high valleys on hourly charts are quite fine. If you're a longer term trader, you may want to take a look at the weekly charts, which seems to be spectacularly good for S&P 500. I should mark this down somewhere so that I can start watching the S&P 500 weeklies, so that when there's a deeper dip like this, I can just buy and pow, hit my max win. Is what's better than that? Anyway, I think this was pretty much everything I wanted to show on this video. Of course, here then I've got my watchlist code. The number kind of here shows the strength of the the strength of the trend on daily. This one. If there's HV, okay, applied materials just got back to the. I need to change this to the daily. So basically, there's a watchlist code telling me what there is triggering on which chart. Then I can just browse it through and see that, for example, MMP, whatever that is, has a deep valleys trigger today. Magellan Midstream Partners, probably something related to oil or energy or stuff, and well, I'm not very excited about these results. Why do I have this on my watch list, I wonder? Alright, well, I should delete this, I suppose. I'm just gonna take MMP away. I don't like that. That's a bad chart. No, it was probably because of the high valleys hit rate. Well, I guess I'll keep it there. The data takes some time to come. Yeah, okay, going over 70%. I'm not gonna delete this. It doesn't look bad. It doesn't look bad. And also here, buy, win. I don't know where this goes. I'm not sure if I want to buy it today. Because usually these deep valleys, when they come, they do a little like that kind of rounding bottom. So I may wait for it to kind of show me that the bottom is in. This trigger here, for example, could have just waited and see, okay, now we have a bottom. We had the trigger, and if we just buy blindly the triggers, we have a good win rate. So how about we just wait for the bleeding to stop, buy in here, risk less, and have a bigger reward potential. I think that's quite clever, especially with the deep valleys, because the deep valleys can become really deep, and at the current points the the indicator is not so intelligent that it would wait. Okay, well, where does the next day go? Well, fell. Where does the next day go? Okay, it didn't fall lower. Where does the next day go? Okay, it closed at the same price. I think this is going to start going higher. Well, it did, and there we go. Bow. Right. Anyway, that's the climbing valleys indicator. That's how you configure it, and that's how you use it. This is by far the best tool I have created up to this point. I hope you fall in love with it, and if you don't have it yet, I'm going to put a link somewhere where you can go to a page that kind of allows you to have access to this sort of stuff. See you around, and climb safe.